Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Strategas chief economist Don Rissmiller. Don, how are you doing today?
Very good, Ross. Good to talk with you.
Good to talk to you as well. I wanted to start big picture. A couple weeks back, you revised your growth estimate for 2025 down, but revised your growth estimate for 2026 slightly higher. Would you mind diving in a little bit to the deciding factor behind each of those decisions?
Yeah, absolutely. So, as we look at the situation right now, there's reason to expect some choppiness over the next few months. So, if we look at how real consumer spending has come in, that's been negative. If we look at nominal personal income, that's been challenged. If we look at some of the survey data, that's been weak for quite some time. So, if there's going to be a weak point, it's probably in the next 3 months. But if we look out to 2026, there are some interesting things coming, particularly on the capital spending front. With the tax bill now becoming law, there is some momentum developing for that part of the economy as we look forward. It may take some time, so this may not be in the next few months, but over the next year or so, I think it is perfectly reasonable to expect business fixed investment to grow and to grow in a way that should boost overall GDP.
That makes a lot of sense. Let's zoom in a bit on some of the choppiness in 2025. The jobs data has been, I think, okay, good enough is probably the best way to put it, but certainly cooling. I wonder if you could dive in on what you're seeing in the labor market and whether immigration reform and some of the demographic issues that the U.S. faces actually makes the case for this level of jobs added being just fine for the remainder of the year.
Yeah, that's an important point, and it's a nuanced point, Ross. So when we look at the jobs data, I'd say it's small cracks, not big cracks still. So we don't have a lot of hiring, but we also don't have a lot of firing. And so the job growth numbers are slowing down, particularly for the private sector. We know there's some issues with the government sector that are going to play out over the next few months. What we're really focused on is the slowdown in private sector job growth, and that is occurring from the data that we see. Still, we don't need 200,000 jobs a month. We may not even need 100,000 jobs a month to keep the unemployment rate flat here, given some of the demographic changes and the changes to immigration policy that you mentioned. So, in a steady state, we may only expect job growth to keep up with what population growth is doing. And if that has changed for those reasons we mentioned, then maybe 90,000, 80,000, 70,000 jobs a month on non-farm payrolls is just fine. And that's where we'll probably settle out in the second half.
Yeah, and that's important because that requires kind of a change in mentality for how we've looked at these job numbers for the past couple of years coming out of the pandemic, where 200, 300, 500,000 what was possible. So it's a good note. I want to focus on something that we've talked about a bit before, but I think is really important, both for the U.S. debt situation and just for growth writ large, given that population situation, which is productivity and particularly the AI story. We've talked about it before, but what are you watching to get an early sense of whether AI or other technology is contributing not just to a one-time uptick in productivity, but something that represents a meaningful change?
Ross, this is important because this is really the best way out. So we know there's a lot of debt. What we really care about is some debt relative to income metric, or for a country, it'd be debt relative to GDP. So what productivity can do is it can make the pie bigger. It can make the denominator, the GDP number, bigger in that calculation. And then the debt problem doesn't look as significant. What I'd like to see is the profits of the technology companies going up at the same time we see the profits of non-tech companies going up. If AI is going to be a general purpose technology that boosts the whole economy, I think we should see it across the board. And there are examples of that with the 1990s tech boom with the internet, or if we look back at the 1950s and transportation and the interstate highway system, anyone could use the road, anyone could use the internet. Presumably here, anyone can use artificial intelligence, but if it's going to boost economy-wide productivity, it should show up in the earnings announcements and the profit numbers, especially of the non-tech part of the economy. And we're starting to see some of that. It should really broaden out, though, if it's going to be as big as we would hope.
Yeah, well, we're in the middle of an earnings season right now. That's a great way to think about this earnings season. Is how are companies in the consumer staples sector thinking about AI? Are they seeing margin expansion? So we'll keep an eye on that. Don, thank you as always for the time. This has been really insightful, and we'll look forward to talking to you again soon.
Thanks a lot, Ross.